Hello, this is Chuck Carnevale, and I'm the Chuck in the Market's Up Chuck. The general market is considered to be overvalued today, but I'm a believer that it is a market of stocks and not a stock market. So I'm constantly looking for value, and I utilize the Fast Graphs Fundamentals Analyzer software tool in order to find value, even in an overvalued market like we have today. With this video, I'm going to cover Dick's Sporting Goods, a stock that the market typically likes to value high, but is currently available at a very attractive valuation. So let me start by taking a look at Dick's Sporting Goods' historical operating results. This orange line represents a PE ratio of 15, or a valuation reference that would be considered attractive for this company. And I want you to notice earnings growth has been very consistent. A couple of weak years coming out of the Great Recession where earnings fell in 2009 and then only rose moderately in 2010. But then since the Great Recession, if I shorten this time frame to 9 years, you'll see that Dick's has had pretty consistent earnings growth of about 11% a year. Now, going back to this longer term graph, I also want to talk about dividends a little bit. This company only started paying a dividend in January of 2011, and they kept that dividend flat for the first 4 years or so, but have recently begun increasing the dividend. This area below this white dividend line represents the portion of profits that they're paying out in the form of dividends, and these are the dividends after they've been paid out. Now, the next thing I'd like to bring in is monthly closing stock prices, because price should correlate with earnings, and it does in the case of Dick's. And what I want you to see here are very clear pictures of overvaluation and undervaluation. As I mentioned earlier, the market does tend to value this stock at a premium price-earnings ratio. The normal PE ratio historically has been 19. If I shorten the time frame, it's been 18.7, which is still a very similar number. But the point I'm trying to make here is we go back and examine, you can see these periods of high valuation, the big correction during the Great Recession, but then every time the market has overvalued this stock, it's come back into reasonable valuation, and these periods of undervaluation have been really extraordinary times to invest in this stock, and I think we have one of those times right now. Another way to look at valuation would be to look at EBITDA, or earnings before income taxes, depreciation, and amortization, and we get a little clearer picture here of historic valuation on Dick's. And once again, we see price tracking EBITDA here, and we see these opportunities where price got below EBITDA turn out to be great times to build a position in this stock. I believe this is one of those times. But as always, I recommend that you do your own due diligence and research on this company. But I think valuation warrants a closer look at this stock. It only has 5% debt. It currently offers a 1.8% dividend yield and is trading at very low valuations relative to EBITDA and relative to earnings. The blended PE ratio on operating earnings today is 11, and that's historically very low for this company. So you might want to take a closer look at Dick's if you're looking for total return. If this stock were to trade back to its normal PE ratio by the end of January 2020, which is their fiscal year, you could more than double your money investing in this stock today. So there's a lot of potential here and a lot of opportunity in Dick's Sporting Goods. Now that we've looked at historical valuation, let's look at earnings forecasts going forward. There are 29 analysts forecasting Dick's to earn $3.70 by fiscal year 2018, which ends January 31st. And there are also 30 analysts forecasting 8% growth for the next year. And this is about as far as I like to go out, although there are smaller number of analysts forecasting some growth going forward. But if you just look at these near-term estimates here, this stock could generate a 35+% annualized rate of return over the next 18 months or so if it goes back to a normal PE ratio of 15. However, as I mentioned earlier, if you look at its historical normal PE of around 18, based on these same analyst estimates, the rate of return could be significantly higher. You could come real close to doubling your money. And as far as analyst estimates are concerned, the historical record of analysts forecasting Dick's has been pretty good. They were a little off in 2016 on a one-year forward forecast, and a little off on a couple of years in the 2-year. But when you look at this overall record, analysts have been right the vast majority of the time, or the company has exceeded analyst estimates the vast majority of the time. So I think it's a well-capitalized company. It has low debt, a decent dividend yield, and definitely attractive on valuation. Once again, this has been Chuck Carnevale, the Chuck in the Market's Up Chuck. Thanks for listening.